Welcome to Illuminati Silver. We tell you the truth about silver. Today is Sunday, the 19th of June 2022, and this video is a repeat of the weekly update we published yesterday. What we have noticed over the past 2 weeks, as we were away the week before, is that equity markets have fallen significantly. So have cryptocurrencies. And gold and silver, whilst to a degree holding up, are also on a downward trajectory. The issue now, of course, is that with the Federal Reserve intent on being incredibly hawkish, at least through July, have we got further to fall? And if so, how far? Well, let's take a look. Well, first looking at precious metals over the last 7 days, we can see that gold has fallen $31, moving from $18.71 to $18.40, having hit a high of $18.79 and a low of $18.05. In sterling terms, gold finished the week at £1,506, down £14, and in euros it closed at 1,753 euros. That's down 25 euros. Silver also fell 23 cents, falling from 21.92 to 21.69, having hit a high of 22.03 and a low of 20.91. So we can see that the pressure has been on the downside for silver. In sterling terms, it closed at £17.76. That's down 5 pence. And in euros, it closed at 20.66 euros. That's down 0.18 of a euro. The gold to silver ratio stands at 84.9, slightly higher than it was 2 weeks ago. And it does certainly seem to be the case now, at least for the past few weeks, that the ratio is comfortable between this 80 and 85 level. And we suspect this may continue a while longer, and we'll explain why in a few moments' time. Now, looking at the prediction we made 2 weeks ago, we stated that we expected to see gold trade between 1800 and 1900, with 1775 and 1925 as outliers, and silver between 21.50 and 23, with $21 and 23.50 as outliers. Well, this prediction's held up pretty well for the past 2 weeks, not just 1 week, with silver dipping just below our lowest outlier range by just 9 cents at one stage. The difference we saw this past week between gold's high and low was $74, which for gold is higher than normal, and silver's difference $1.14, which is really pretty average for the course. Now, looking at some of the other financials, to think that 2 weeks ago, Bitcoin stood at $29,594. But at the time of reporting today, it's just $19,361. That's a difference of over $10,000. It's taking a hammering, as well as stock markets, which we shall now go on to. The Dow Jones closed on Friday at 29,888, down 38 points on the day, which in itself is nothing, but it's actually down over 3,000 points over the last 2 weeks. The S&P 500 closed at 3,674, just up 8 points on the day, but nevertheless down 434 points on the last 2 weeks. And the Nasdaq closed at 10,798, quite bullish on Friday, up 152 points. But when you compare that with a loss, wait for it, of 1,214 in the last 2 weeks. What a time for us to go away, hey? And this is why, to a large extent, Bitcoin and cryptos have also been hit. Because generally, they're not inextricably linked, but generally the direction of the Nasdaq tends to be the direction of Bitcoin. As I've said, not inextricably linked, but there is some form of informal relationship between the two. Now, slightly good news, Brent and WTI crude are down. Brent down $6.60 at 113.12, and WTI crude down $9.31 over the last 2 weeks at 109.56. Still far too high in our opinion, but nevertheless, any reduction is welcome. Now, the dollar index has no intentions of reducing, and that stands at 104.70. That's up 2.56 points on the last 2 weeks, and even today, or the last 24 hours, has been above 105. So, economically speaking, what's happened since our last report? Well, of course, the big news was the FOMC of the Federal Reserve raising interest rates by 0.75%, or basis points, as some like to call it. The first time we've had such a rise for 28 years. And the promise of another substantial rise next month, though some are predicting 0.5% in July, and others not ruling out by any means 0.75%, including the Fed Chair Jerome Powell, who quoted at the time of the interest rate rise on Wednesday, quote, "I do not expect moves of this size to be common. Either a 50 basis points or a 75 basis points increase, though, seems more likely at our next meeting." Now, this means that the Fed funds rate now stands at 1.5 to 1.75% and will be well above 2% next month, and many are predicting 3.25 to 3.5% by the year end, which is where we placed our limit on their rate rises when the fall of interest rates ceased some now many months ago, and we believe 3.5% is still affordable for the US government to tolerate. Not much above that, though. We've also seen the CPI index rise in May by 1%, providing a year-over-year figure of 8.6%. Retail sales were down in May. In fact, they were minus 0.3%, and that compares with plus 0.7% in April. Building permits and housing starts were also down in May, as was the industrial production index. So economically, things not going well at all. Now, if we look at envisaged economic reports this coming week, well, nothing on Monday. We have what's called the Juneteenth holiday. Tuesday, we have the existing home sales for May. Wednesday, though, Jerome Powell testifies to the Senate Banking Committee. We think that might be worth listening to. Thursday, weekly jobless claims and flash S&P manufacturing and services PMIs. And then on Friday, we have the UMich Consumer Sentiment Index for June, new home sales for May, and 5-year inflation expectations. So this week now coming, the flash PMIs will be noted, but Jerome Powell's statement on monetary policy will probably grab most of the analysts' attentions. Now, for those of you who listened to our 3rd of June update, we stated, quote, that despite some dovish talk by analysts, we suspect the Fed will still remain hawkish in its next round of interest rate rises because they like to see 3 months of data before changing perspective. We could be wrong, but we're still expecting some not so tasty medicine in the weeks ahead. Well, it only took a little over a week, and some unpalatable medicine has already been given, with more, we are sure, to come. Now, for those who think, oh, this won't happen as the Fed will not allow markets to fall, stock markets to fall further, please be minded that if the Fed does not raise these rates, the markets themselves will do it for them. Because at the end of the day, the inflationary pressures and the real rates of interest, the difference between the interest rate and the inflation rate, will drive markets naturally. And in addition to that, from a political perspective, also as an economic one, preventing inflation rising even further is more important than stopping the equity markets from falling another 10% or so. After all, a 25 to 30% fallback could be deemed healthy for equity markets longer term. So we would not be surprised whatsoever to see the Fed allow another 10 to 15% fall in equities before becoming overly concerned. Now, before we look at the technicals for gold, it's worth noting that this past week we saw gold fall some $70 between Monday and Tuesday, rise then on Wednesday and Thursday, only to fall back again on Friday. And this is the conflict traders are having at present when trying to determine which is most impactful? Rising inflation, which generally is good for gold, or rising interest rates to combat that, which generally is bad? Now, according to Bloomberg News, quote, June 2022 will certainly be a month to remember in central banking. Global monetary policy makers have laid out the most powerful tightening campaign since the 1980s, with a number of central banks embracing interest rate increases of a size unimaginable at the start of the year, end quote. Okay, enough of the rhetoric. From a technical point of view, gold is just below the 200-day moving average of 1843, and we have some support at 1830, with very strong support at the 78% Fibonacci retracement level of 1765. We have a number of resistance points between gold's current price and the 100-day moving average, which is just shy of 1890, with strong resistance at the psychological level of 1900. Silver is clearly under pressure, and at the 2050 level, we believe this is crucial in terms of dictating trend. If silver falls below 2050, which so far has proven to be supportive, then $20 to as low as potentially $18 could be on the cards. To the upside, we need to see silver break 2250 and then 23, and if it does, we could see a nice rise to the 50-week EMA of 2361. Frankly though, we're not convinced that's going to happen, and we're more negative silver than positive short term. Now, both gold and silver are of course influenced heavily by the value of the US dollar, which we expect to remain high, as we cannot see the UK and the EU Euro area being as hawkish with their interest rates as the US plans to be over the next few months. So in view of all this, what can we expect to see happen to gold and silver prices this coming week? Well, not allowing for any geopolitical tensions worsening or improving, i.e. the status quo continuing, we expect to see gold trade roughly between 1790 and 1890, with 1760 and 1920 as outliers. We forecast silver will trade between $20.75 and $22, with $20 and $22.75 as outliers. Of course, black swans, major geopolitical news, tensions rising or completely diminishing, i.e. the instant announcement of the Ukraine-Russia war being over, then that will have a dramatic effect on prices, though we're not envisaging any of that as yet. What do you think? Where do you see prices going over the coming week or weeks? We certainly think they're going to be under some pressure. Meanwhile, this video is long enough. Thank you so much for listening. If you haven't already done so, please subscribe to our channel, not forgetting, of course, to press the bell sign so you're notified of our videos as and when they're published. And tomorrow, we shall be repeating this video under a different thumbnail and headline. Remains for us just to say thank you for continuing to follow us. Sorry about the week lapse, and we wish you a heartily safe, enjoyable weekend, and as always, a prosperous week ahead. Illuminati silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.